Today, we're going to talk about how to get rid of that pesky PMI, which is private mortgage insurance, on a conventional loan by focusing on a couple of different methods, potentially saving you hundreds of dollars per month. Hi, I'm Gordon Baker with RE/MAX Alliance Group, and I'm going to talk about ways to remove PMI, private mortgage insurance, possibly sooner than you think without refinancing. First of all, what is PMI? Private mortgage insurance is insurance required by the lender when the down payment is less than 20% to compensate for the additional risk associated with a smaller down payment. Depending on the size of the down payment, 3, 5, or 10%, the private mortgage insurance amount will vary. Let's review the ways PMI can be removed from a conventional loan. The first way is what is called automatic termination. In fact, the Homeowners Protection Act of 1998 requires the lender to automatically terminate or remove PMI on the date when your principal balance is reduced to 78% of the original value of your home. At closing, you should receive a private mortgage disclosure form informing you when that 78% LTV loan to value or 22% equity will be reached. This is based on the scheduled principal reduction from mortgage payments compared to the original value of the home. This could take a while depending on the interest rate and down payment amount, so check that disclosure. You can also confirm this by looking at an amortization schedule for your loan. Are you learning something from this? If so, like the video and subscribe to be kept in the loop with future real estate content. The next option requires the homeowner to be aware of the loan balance, comparing this to the original value, and requesting PMI removal in writing to the lender once the equity reaches 20%. Now, this can be important when the homeowner is making extra payments, building equity earlier than is outlined on the PMI disclosure form. One caveat is the loan must be at least 2 years old and have 24 on-time payments. If you went into forbearance, this may be delayed. Now, pay attention to this last method. It is often overlooked but more beneficial since it is based on the current market value of the home, not the original value. In a market where there has been consistent appreciation, this could help you eliminate PMI much quicker than you think. However, it requires that the homeowner be aware of the outstanding loan balance, which shouldn't be a problem, you see it every month, and equally important, the current market value of the home. The homeowner or borrower will need to make the request to the lender in writing to remove PMI. The loan has to be at least 2 years old with on-time payments. So let's look at an example. Let's say you purchase a home for $400,000 with a 5% down payment, which is $20,000. Since it is less than 20%, you'll need private mortgage insurance. Your loan amount will be $380,000. Let's say that in the first year there's 8% appreciation and the market value is now $432,000. This means the equity is now $52,000, which represents 12% of the market value. Now, we have to get to 25% equity to remove PMI under this scenario. Assume the same appreciation for the second year, so the value is now $466,560, increasing equity to $86,560 or 18.6% of the market value. Now let's continue with 8% for the third year, and the market value at the end of 3 years is $503,884, with equity from appreciation rising to $123,885 or 24.6% equity based on the market value, just shy of the necessary 25% requirement. However, with a principal reduction from payments over 3 years, probably around, let's say, $20,000, this increases the total equity to more than $143,885, just over that 25% equity threshold, allowing PMI to be removed in just 3 years. At that point, the homeowner will need to request in writing that the PMI is removed, and appraisal will most likely be necessary to confirm the market value of the home. Now, in summary, PMI can be removed through automatic termination by increasing equity because of the principal reduction through monthly payments based on the purchase price or original value of the home. The homeowner doesn't need to do anything. By law, it will be automatically removed when the equity reaches 22% based on the original purchase price. Next, making a written request to the lender for removal when the equity has risen to 20% based on the original price because extra payments may have been made, accelerating that principal reduction. Now, my favorite, taking advantage of appreciation by making a written request to the lender based on the current market value, reaching 25% equity. The great thing about this is that it recognizes principal reduction and market appreciation in calculating the equity in the property. The first two only took into account the principal reduction. Now, in an appreciating market, this will allow you to remove PMI earlier, saving hundreds of dollars per month. Most likely, it will require an appraisal. As in the previous scenario, you'll need to make a written request. These methods can be carried out without refinancing and are applicable to both primary residences and second homes, but only apply to conventional loans, not FHA loans, unfortunately. Now, if you're going to calculate the equity based on the market value, you'll need to have a good idea of the current value. If you're living in the Phoenix area, please call me and I can give you a hand with that. Now, if you're the beginning of the home buying process and are wondering about closing costs and avoiding common home buying mistakes, I have a couple of videos that can help you with that. Now, make sure and subscribe so you'll receive more real estate information that I frequently post. Thank you.